think we got this solved. Let's get Instagram up and running. There we go. All right, Instagram up and running. We are back when you guys start coming on. Let me know if everything is good. Do I have sound? Do we have sound going? Will you give me a thumbs up if you can hear me? Leave a comment if you can hear me. At the bank, I feel that having trouble. No box. Okay, no box. We got the box gone. All right, everybody can hear me? No box. Box is gone. You're brokey. Okay, audio sounds funny. Let me know if you guys can hear me. Is audio okay? I got some thumbs up that you can hear me. Let me know if audio is good. Can I invest in your hedge fund? So I don't have a hedge fund. We are, what we do, it's called private real estate, or you could call it private equity real estate. So we go out and raise money from investors. There's no public aspect to our firm. And then that money goes into basically real estate investments that, we're going out and finding. So can you invest in the projects we're investing in? Potentially, if you are interested, if anybody wants to learn more about our investments, just DM me the word invest. And it's going to trigger a software. You can put in your information. Someone from our team will reach out to you and see if it's a good fit. Perfect sound and visual. Official John. Thank you, G. Glitching. Kenny, I'm glitching for some. What is the minimum amount of money I can invest with you? So right now, the projects that we have available, it's a little bit higher of a minimum investment. It's $100,000, which is significant. And that is mainly because you have to be an accredited investor to invest in these projects. And so there's just requirements, unfortunately, that the SEC puts on investors who are going to invest in your offering. But I don't think it's going to be like that forever. I can't say more than that because we're working on something. But if you want to invest with us, you want any information on the projects we're doing, we actually have our last project closing in about 30 days. And that will close. That's the last project that's going into the fund. The fund's going to close when we do that. And so if you want to hear more about our projects, just DM me the word invest, and then we will send everything over to you. Here we go from Grindline Media. Mikey, I want to invest, but I'm broke, dog, but I still want to learn. Look, you got to start somewhere. And what you just said is actually the best thing. Learn how it works, and then you have basically the tools so that when you have the money, you deploy it. Or if you want to do it yourself, this is the thing that we always forget. And I'm not saying this is easy. It's not. But if you can find opportunity, people will invest in that opportunity, or people will pay you for that opportunity. So I know everyone says you have to have money to invest. That's only if you're trying to invest passively. If you don't want to invest passively, well, that's not the case at all. Like, you can start your own business, or you can find deals and you can bring money together and you manage that opportunity. It means you have to learn, right? Like, yeah, it's going to take effort, but you can build equity through, it's what we call sweat equity. You do the work, you get to participate in the upside. So don't forget that that is an option. If you want to invest passively, that's somebody said it. GPLP is the easiest model. Colton Buck. So that's what our company does. It's a GPLP structure. The LP is the limited partner. This is for, really the premise of our firm, the company that I started, Commune Capital, it is to bring real estate to investors who don't want to do the work of finding the project, getting it under contract, lining up the financing. We build. So the development, they don't want to do any of that, but they want to be invested in real estate. They want cash flow. They want appreciation. Maybe they want some of the tax efficiencies that real estate create, but they don't want to do the work. That's where a passive investor comes in. Now, do you need to have money to invest passively in alternative investments? This is private equity, venture, private real estate, private credit. Yes. But remember, you can invest passively in more of the traditional vehicles. Like when I started investing, I wasn't making a lot of money. I was investing in, my Roth IRA. I started a SEP IRA. I was investing in the stock market, a little bit of bond exposure. Like I wasn't making big investments. A lot of people are into crypto now, right? Every golf series I do, I'm either winning or losing crypto. Like it's not about how much you have, it's about consistency, because how investments work, these things love time. Like compound interest is, what, Albert Einstein, somebody labeled it the seventh or eighth wonder of the world, or ninth one. How many wonders of the world are there? I don't even know. But compound interest is crazy. Like how your money makes money on itself is crazy, but you start really seeing the power of it over time. And so don't get encouraged that you don't have a lot of money yet. Just get started. And then you end up looking back and you're like, dang, I have a lot of money. This is how homes work, right? Like you buy a home and then over time, a portion of your mortgage goes towards principal payback. It happens a little bit later in the cycle. But as a home appreciates and you're paying down the debt, you end up having a lot of money tied up in that house. That's just time, considering, you didn't get the unique moment of 21, 22 appreciation. But historically, it's just time and discipline. How much percentage will you return roughly? So we have a handful of offerings. The offering that we are about to close on, which is our apartment fund. If you're looking at average annual return as a model, it's a little over 20%. If you calculate it as IRR, it lands somewhere around a little over 15%, or it's a doubling of your money in 5 years. So it's basically the potential of 2xing your money in 5 is what we're projecting to do. Do you agree with Ray Dalio's investment portfolio percentages? Okay, this is actually what I was saying before the live cutoff. This book it's worth reading. Holy Grail of Investing. It's Tony Robbins' last book. His first book was Money Master the Game. It was good. I didn't read his second one. I think it was on asset allocation, if I'm not mistaken. And then his third book, The Holy Grail of Investing. Now, as you read it, this is what you're going to see. There's a ton of good information in it. He's selling his fund pretty heavily in it as well. But what Ray Dalio talks about, and this is what we were talking about in the last live before the square jammed me up. What you want to do with your portfolio is basically take as little of risk as possible while still capturing a lot of upside. Like usually when we invest, a high risk investment has the potential of a high return, but also has high risk of you losing your money. Then you go all the way to like one of the safest investments, maybe a treasury bill. It's very, very low risk of you losing money, but it's very low upside return. So how do you put yourself in a position where you're removing risk and still capturing upside? And this is basically Ray Dalio's framework of what creates the holy grail of investing. So what he's saying is you need 8 to 12 uncorrelated investments. Now, how you find uncorrelated investments has become a little bit challenging in the current environment we're in. So historically, what basically you would do is you would have stock exposure, you would have bond exposure, and then maybe you'd have like public REITs, for example, right? So when stocks are doing good, bonds typically are not. And then when bonds are doing good, stocks are not. You kind of have some protection there where you have investments that are performing better in hard times and then vice versa. The challenge is the last 2 cycles, all of those came down together. It was like stock market, came down, bond market came down with it, and then, public REITs, which is a public way of having real estate exposure, they all came down together. So finding uncorrelated investments is a little bit harder now. Now, where Tony Robbins basically started talking about in this book, if you haven't read it, is alternative investments. These are private equity, private real estate, and private credit. So I did a video yesterday explaining this. Private equity basically just means that investors are coming together and they're putting their money directly into usually business. So there's no public markets at play, right? Or you can put private money together and buy a public company to turn it private. So, if Elon would have brought a bunch of investors together to buy Twitter and make it X, that would have been a private equity type of deal. Then you have private real estate. That's what I do. We find real estate deals. We go out and raise money from individual investors, and then we put that money into real estate projects. Private credit is basically lending. So we'll all put our money together, and then we'll lend our money to either businesses or real estate. And so that is a part where, one, the historical performance over the last 35 years has been really good and much higher than the S&P 500 has been. It's about an average return of 14.2% over the last 35 years, where the S&P 500 has averaged about 9.2% in that same time frame. But you get the uncorrelated aspect. It's like the real estate market and the stock market do not move together. Like you saw, the stock market will get a piece of bad news and it will come down. Maybe the inflation numbers are high, stock market drops. Real estate doesn't move. So you want to find investments that don't move together so that you can still get your upside and bring down your downside. Dalio is brilliant. Like this is one of the greatest investors of our time. So I think it's smart. Now, what Tony Robbins says is, what happens if you invest in multiple low risk for your portfolio? You can invest in multiple low risk investments. You're really, when you're looking at building out your portfolio, there's a handful of factors that go into it, right? You have your age, you have your risk tolerance, you have your capacity, you have goals. And so you try to build out your portfolio to invest in the assets that line up with yourself and your goals. So I'll use me, for example. I'm young, so if I take losses, let's say I'm in the stock market. If the stock market basically corrects, and let's say it drops by 20%, I'm young enough to wait it out, right? So my age is good there. When I'm making investments, you're looking at risk tolerance, right? Are you somebody who's more comfortable taking high risk, or are you somebody that's more risk adverse? You don't like the idea of risk. That's going to basically determine what you're investing in. And then you have capacity, right? If you're somebody who is totally comfortable taking high risk, do you have the portfolio and do you have the capacity to handle that type of risk? Those are factors. And then as you get older, typically what you end up doing is you start scaling back on risk. You probably start looking more towards cash flow and less towards growth. And so all of those factors come into play. Look, I have friends my age that are so risk adverse that the idea of investing in anything freaks them out. That's not me. I'm more on the other side of the spectrum. I have a higher risk tolerance. I have the highest risk tolerance when it's a company I'm building. And then when I'm investing passively, I'm still comfortable going on the wealth build kind of momentum. Like, I don't need cash flow right now. I'm trying to double my money over and over. So if I can find investments where I'm doubling my money every 5 years, that's kind of what I'm looking for right now. Will that change as I get older? Of course, it definitely will. Skater, fire sprinkler, fitter. Do you have the power to pick contractors for your construction jobs? Yeah, of course. Yeah, we do. We totally do. Put $100K on Lakers to win finals. You will be fine. So when it comes to even Bitcoin, right? Bitcoin is probably the highest risk investment I have. Well, that's not true. I've got some in some really high risk coins, right? But let's just say crypto in general. Crypto is the highest risk investment that I have money in, but the percentage of allocation I have in crypto is so small that truthfully, it doesn't matter if I lose it. So I'm of the personality that if the risk is going to be through the roof, I don't want to risk any amount of money that if I lose it, I'm not going to be able to sleep. And then, it goes as you get into investments at lower risk, you usually allocate larger dollars to that. Let's see. Let's answer some questions. I know this is very basic and off topic. I run a shop head to toe that's become passive for my buddy. I've gained locals, but outside of that, how should I go about marketing it to outsiders? All right, so, I mean, the way I do it, social media. Like, you know, one thing that I'm actually not good at with social media, and this is what I would encourage you to do, and it's something I'm trying to get better at, bring people along the journey. Like, bring people behind the scenes and show them what's going on. I love that, right? Like, so, for example, if you're running your shop, start filming the day-to-day process. Like, find a challenge, right? What's one of the hard things about running a shop? Bring people along that challenge and you know, bring them along how you find a solution, what the outcome is. That type of marketing is so powerful. You end up like building a community of people like feel like they're going through experiences with you. It's really good. One of the challenges and why I have a hard time with that is more the type of business I have. We are so heavily regulated that it's a little bit scary, I guess is the best word, to show certain people behind the scenes in case there's a computer on, there's investor information. Like there's a lot of liability for us in doing that. So I'm always trying to find the balance of how you navigate that with the business I'm in. But I would get on social, you know, where I would spend my time would be Instagram, TikTok, and YouTube. And tell stories. That's the whole thing. Tell stories and bring people along with you. That will get the marketing out there. And then I would say, lastly, paid advertising is actually having a pretty big rebound right now. My buddy Eric Bork runs a big like paid or digital marketing agency. And I was over there a couple weeks ago and he was showing me the numbers or the returns on basically ad spend that results in revenue. It is psycho right now. Like the TikTok platform for ad spend is pumping. Instagram's doing well. So if you know somebody that's really good in that space, I think you can make the argument that paid advertising you're going to see, dependent on what you're highlighting and selling, is going to be a pretty big tool to get your brand out there. Have you seen the refusal of anyone purchasing U.S. debt because the bonds will lose purchase power over the next 10 years? I haven't been looking at that. I do know that we have a lot of money trying to come into the U.S. that at least we're seeing on the private side. But as far as buying up our debt, I would need to look into that. I think they want to own more businesses and land that we have. It's worth it, though, if you're not able to spend it. Let me get some more questions. Thank you so much, brother. I got you. And look, support 7 Local. I'll tell you right now. Give everyone in here some details about the shop right now. Like, why don't you send me a comment where you're located and what your address is or what your website is, and let's try to get some people over there. Connect me with Eric. Okay, look, I'm going to give everybody Eric's Instagram and DM him. For anyone who has a business that's looking for paid ads, this dude is a freaking machine. It's just Eric Bork. So here's his profile. Put in Eric, ERICBORK. DM him. Tell him I sent you. He's doing really, really well with this. All right. And he's got some like massive clients. Like people spend a lot of money on paid ads because once you figure out the math, like why not, right? Would it be better to pull equity from a rental and reinvest it into the stock market or into another property? Roughly 100 to 150K in equity. Okay, so there's Vic, it depends. So some of the things that you're looking at is if you pull equity out, how are you doing it? If you're going to do a cash out refi, Just be careful because your interest rate is going to go up. And if it goes up, you're losing out on cash flow and you're basically spending more money on debt than I think you need to be. So be mindful of that. If you're going to take it out in, the form of a HELOC, run the numbers. What does that do to your cash flow with the added debt burden? And then what is the potential of earning power that you have in the next investment, right? And look at what your true opportunity cost is. And if it doesn't put you in a position where you're taking on too much leverage and you have the potential to make more in a different investment, then that could be a good opportunity. But I try not to take crazy amounts of leverage in real estate because for me, I don't want options that are going to be put on the table for me to be forced to sell something. So, if we're talking specific to real estate, we're all going to go through corrections. It's inevitable and it's healthy, truthfully. So if you go through a correction and cap rates soften, which means the value of your property is going to go down, and let's say occupancy or let's say vacancy increases, which means your rents are going to come down. If those things happen, you want to make sure that your asset can very easily pay your expenses and your debt service, and you still want to be making positive cash flow from it. And so when you have assets that can get through those hard times fine, and you're still basically getting paid your income, that is the best position to be in. Where you end up getting squeezed is when you over leverage and then there's a correction, and then either you go negative cash flow or your loan comes due. That's when you're in jeopardy of losing good assets, and you don't want to be there. When there's corrections, you want to be in buy mode, right? You want to be taking advantage of assets at sale. You do not want to be scrambling to fix your portfolio. So I would say, if you're using my company, for example, I think this is one of the best opportunities to buy. We're seeing cap rates move. You're seeing discounts. You're seeing, operators that took on too much leverage and now are distressed because they can't qualify for their permanent financing. This is when I want to buy. If all of our projects were super high leveraged and we had loans maturing right now, we couldn't spend any time on buying right now. We would be spending all our time trying to protect what we have. And instead, we're raising, how would I say this? Because the year's not over. Our capital raise for this year and next year is higher than we've ever had in history. We have more projects lined up. We have more closings. We are in go mode. That's where I want to be. I want to be taking advantage of those of projects or assets on sale. So just be mindful of that. All right. We spent some time in a patio in Lawrence, Kansas at Skate Day in St. Joe with Malto. I want to start a fire sprinkler company, and it would be great to follow you guys around. I love it. I haven't been to Kansas City in too long. We were looking at a project out there not too long ago, and it reminded me that I don't think I've been to Kansas for at least a decade. So I need to get out there. Carcass, hit me up. Anything I could do with other skaters and business, I'm trying to do it. In your work history, has your business invested in any portfolios that have gone bust? Okay, so for my business, we don't invest in other people's portfolios. We invest in real estate, and the real estate that we invest in, we are the investor. And so, have projects on the equity side. Projects haven't gone bust. There are projects that did not go according to plan. That is actually normal. It happens all the time. But all of our equity investments, which means we purchase them and own them, all of them have made a pretty good return. The projects that become distressed is we have a lending portfolio, so we are the debt on real estate. In that business, it's inevitable that there will be borrowers that aren't going to pay. And when they pay, you have to take assets over, so you foreclose on them. And so I would say in that case, yeah, maybe that's the sign of a project not working out because the goal is for the borrower to pay you back and then pay you in full. But how you hedge against that is you lend a certain percentage of the value. So, when you hear us say things like loan to cost or loan to value, that's your protection ultimately if things go astray. So if you lend, let's say up to 65% of the value of the building, and then they stop paying, and then you have to take it over, usually when, I guess it goes according to plan, you try to take it over and then sell it. And if you have to sell it at a discount, you still try to sell it for more than the 65 cents on the dollar that you're in. And so that's just part of the business. But no, our funds and our returns to investors have been positive since we started the company. I don't think Commune has ever lost money for an investor. And then my business before that was a craft brewery. We didn't lose money for investors. We actually made a ton of money for investors. So far, I would say in the last 11 years, when I've brought investors into the businesses that I'm doing, I have not lost investors' money. But I personally have invested in companies that I lost my investment on. That's part of investing, unfortunately. Now, it wasn't real estate deals. There were some investments I made in startups, so a little bit more high risk that didn't work out, but unfortunately, that's how it goes. I would say what I try to do, and one of the disciplines that I try to maintain is anytime I make an investment, before I make it, I write down basically what the opportunity is, what I think the risk is, and why I'm ultimately making the decision. And then when the investment goes right or if it goes wrong, I try to go back to the decision making that I made to see if there was anything I missed and anything I needed to learn from, or if I actually felt like I actually made the right decision and something just went wrong and it didn't work. And then also when things go right, like sometimes, people just get lucky and we think we're a genius when it comes to investing. It's good, I think, to look back and see how you were underwriting the project and the things that you got right and then the things that you got wrong, so that when you're making the next investment, you're becoming a better investor while you're doing it. Can confirm as a commune holder. You're such a legend, G. I appreciate that. Yeah, we've had like to give you guys context, we have multiple different funds. But if you take basically all of our projects together, so our equity investment from the history of our company, it's been about a 20% net IRR to investor, which is that's pretty good numbers. So far so good. Thanks, Mikey. You got it. Heck yeah. I put together a property strategy optimization model and found that a lot of the properties that I can double my money in 5 years could instead 10x your money in 15 years. Overall, a better investment. Colton, yeah, really, really good point. So this is something that I'm actually still trying to figure out the best solution for when it comes to owning a business that brings on investors with you. Is like, for me personally, I don't want to sell real estate. Like I want to buy real estate and own this stuff forever. But when you're bringing investors in, usually anything past a 10-year hold is too long for investors. Like it seems like an eternity to them. But here's the added challenge is once an investor comes in, and let's say you're showing a 5-year model, and then you end up selling it, you get a lot of calls from investors going, why did you sell? Keep holding it. So it's almost like this. If you present a 10-year hold, people don't want to come in. But if you present a shorter hold and then you sell it before 10 years, there's frustrated because there's a taxable event. And so I don't know. I think we're just always trying to navigate the best way to do it. But from our experience, which is we have about, I believe we have about 550 investors total. It seems like that 5 to 10 year hold is the desired hold period for the majority of investors. And that's where we land on underwriting a project. But I hear you. If you can double your money every 5 years, but you have a 15-year hold, so you're doubling. I love the idea of that, because then you got the same growth happening without the taxable event. Total novice here, but I saw your post about private investment and want to look into that. Any pointers? You guys take on smaller investment. Okay, so this is what I would recommend. Send me, DM me the word invest. Just write invest. It's going to trigger our software for you to put in your information. And then if you're an investor that is looking for a smaller minimum investment, at least I'll have your information. And if we ever have that investment come basically to market, I will reach out to you immediately. But I don't know how long that's going to be. So if you want to learn about private investments, the book that I am kind of telling people about right now, because I just am getting close to finishing it, is Tony Robbins' The Holy Grail of Investing. He talks about private investment a lot. Some of the platforms that you can look at, there's platforms like Fundrise, there's CrowdStreet, I think there's Yield Street. There's a lot of platforms now that will plug what we call retail investors, which just means investors like us, with operators from private investments. So you can check out that. I would read that book. It's been a pretty good book. And then for anyone that wants to hear what we're doing, we have a closing in about 30 days. If you want information on it, just DM me the word invest. It will trigger our software, and we'll have somebody from our team reach out to you. All right, so tonight I have a dinner with my wife. We're going to go to a really good pasta restaurant in town. So thank you guys for spending some time with me. I love you all. Have a phenomenal rest of the week. Have a great weekend.